Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to uncover the real story behind the numbers. And today we've got a proxy statement from NextTrip Inc. That's quite a ride full of interesting proposals, and yes, we're going to decode it all for you. First off, get ready because this company is asking its shareholders to approve some pretty significant share issuances that could really change things for existing investors. We're talking about potential dilution, so let's dive in and see what that really means. Alright, so this document is essentially a proxy statement. It's what a company sends out before its annual meeting of stockholders to tell everyone what they'll be voting on and why NextTrip has its annual meeting scheduled for October 7th of 2025, and they're holding it virtually, which has become pretty common now. The big news here is that the board is asking for approval on a bunch of proposals that involve issuing a lot more company stock. This is often done to raise money, but it can also dilute the ownership stake of current shareholders, meaning your percentage of the company shrinks. First up, they want to elect 2 directors to their board, William Kirby, who is also the Chief Executive Officer, and Jimmy Bird. Let's take a quick look at who they are. William Kirby has a really extensive background in the travel and media industries with over 2 decades of experience. He was instrumental in developing the NextTrip model and has held leadership roles in various travel and media companies since the early 2000s. Basically, he's been in the travel business for a long time. Jimmy Bird brings over 2 decades of operational and corporate development leadership, especially in North American infrastructure and communications. He's currently the Executive Vice President of Corporate Development at Ledcor Group and has been key in growing their communications infrastructure business. Next, they're asking shareholders to ratify their choice of Haney & Company as their independent accounting firm for the fiscal year ending February 28, 2026. This is pretty standard procedure to make sure shareholders are comfortable with who's checking the company's books. Looking at the fees paid to Haney & Company for the fiscal year ending February 28, 2025, the company paid them $1,220.33 in total. This is up from $950 for the prior year. The audit fees also increased from $7,800 to $98,500, and there were also audit-related fees and tax fees adding to the total. Now we get to the core of this finding, proposals 3, 4, and 5. These are the big ones involving those share issuances. Proposal 3 is asking shareholders to approve the issuance of over 19.99% of the company's outstanding common stock. This is happening because of conversions of several series of preferred stock, the series J through P, and the exercise of certain warrants. These were all issued between late 2020-29, 9% of the company's outstanding common stock. This is happening because of conversions of several series of preferred stock. The series J through P and the exercise of certain warrants, these were all issued between late 2024 and spring 2025. Basically, the company issued these preferred stocks and warrants, and if they all convert or get exercised, it will result in a lot of new shares hitting the market. This requires shareholder approval because it's a significant chunk of the company's stock. If shareholders approve this proposal, it means they'll be issuing over 2.8 million shares from preferred stock conversions. And if all those warrants are exercised too, that's an additional 1.97 million shares. This will result in a significant dilution to current stockholders, potentially up to 1/3 of their ownership stake. They explicitly mention that this could negatively impact the stock price and dilute their book value per share. Proposal 4 is related, but it focuses specifically on the Series L preferred stock that was issued to certain insiders, including the CEO William Kirby and the chairman Donald Monaco. It also requires shareholder approval because NASDAQ rules consider issuances to insiders at a price below market value as potential equity compensation, or 7N. Here we see the CEO and chairman converting their own promissory notes and deferred salary into Series L preferred stock. The company is seeking approval because NASDAQ might see this as rewarding insiders without them directly paying the full market price. If shareholders approve this proposal, it means another 1.07 million shares of common stock could be issued to these insiders, resulting in about 11.8% dilution for other shareholders. They highlight that their CEO and chairman have a substantial interest in getting this approved. Proposal 5 is about an equity line of credit with alumni capital. They want approval to issue more than 19.99% of their outstanding common stock under this agreement, which allows them to sell shares to alumni capital at a discount to the market price. The deal with Alumni Capital allows NextTrip to sell up to $10 million worth of stock, but the price is set at 89% of the 5-day average closing price. This is definitely a discounted issuance, and that's why they need shareholder approval to exceed the 19.99% limit. If shareholders don't approve this, the company's ability to raise capital through this equity line will be severely limited. This is a pretty direct statement about the importance of this approval for their future funding. Finally, Proposal 6 is pretty straightforward. They want the option to adjourn the meeting if they don't get enough votes on the other proposals. This gives them more time to gather those votes. Let's peek at the ownership table to see who's holding what. William Kirby, the CEO, owns a fair chunk of the company, about 16.8%, and Donald P. Monaco, the chairman, holds an even larger stake at 19.0%. It's interesting to note the details here, like shares held by entities they are associated with and the shares that could be issued upon preferred stock conversion, which they mention are contingent on shareholder approval, so their current ownership might be even higher if those approvals go through. David Young, a director, holds about 9.9% through his investment in the company. Collectively, the executive officers and directors own a significant portion, about 47.6% of the company's common stock. As of August 2025, this shows strong insider alignment. The company also has a section on transactions with related persons. This indicates that there have been several loans and investments from insiders like William Kirby and Donald Monaco that were later converted into preferred stock, which are now subject to these approval votes. Now let's briefly touch on executive compensation. We see William Kirby, the CEO, receive $4,000 in total compensation for fiscal year 2025. This includes a base salary was deferred. This pay versus performance table is quite revealing. We see the company's net loss increasing significantly over the years. Net loss climbed to over 10 million in 2025 from about 7.3 million in 2024 and 5 million a year before that. Meanwhile, the stock price has been very volatile, going from 45.6e per share in 2022 down to much lower levels. This indicates a tough financial period, which makes you wonder about the justification for issuing shares at a discount. Overall, NextTrip Inc. is clearly in a growth and fundraising phase. They're seeking shareholder approval for several major share issuances that will dilute existing shareholders significantly, but are presented as necessary for future capital raising with their equity line of credit. And preferred stock conversions, the financials show a company with increasing net losses, which makes the timing and terms of these share sales even more critical. The insider ownership is strong, indicating confidence from leadership, but the dilution impact is substantial and something current investors will need to carefully consider. So what's my take on this? Well, a company that's consistently losing money and needs to raise capital by selling stock at a discount to market price usually means they're in a tight spot. The proposed dilutions are substantial and could significantly impact the value of existing shares for current shareholders. They seem to be betting on future growth to make these dilutive financing rounds worthwhile, but it's a risky path. Alright, that's our deep dive into the NextTrip Inc. proxy statement. What do you think about these proposals and the potential dilution? Will you be voting to approve them or against them? Let us know your thoughts in the comments below. If you found this breakdown helpful, please smash that like button and subscribe to Corporate Decoder for more in-depth analysis like this. Don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching. See you next time.